time for the Personal Finance Corner. Let's go across to Vishal Kapoor, GM Wealth Management at Stanchart. Vishal, hi, afternoon. For the benefit of retail investors who are watching us, what is your view on the equity market right now, given the political scenario that we are in?
I think there is, of course, the immediate political outcome that everyone's focused on. But I would also think that we need to look at the broader or the global market outlook, because a lot of the rally currently does seem to be fueled by FII investing. Now, globally, there are two events. One is, of course, the US Fed and the talk about tightening of monetary policy. The second is the developing geopolitical risk in Russia and Ukraine. Now, both these events are things that one should watch out for, because any risk of sort of rally or event for emerging markets would mean that some amount of money may leave the Indian markets. So that's a bit of a downside that one should be cautious of. Having said that, of course, there is, I think the market seems to be headed in one direction given a certain belief and FIIs investing. So watch out for volatility in the near term. Because there are risks out there, and there is the immediate momentum that seems to have been built up. So on a net basis, I would say that if you have fresh money to invest, look at all assets, not just equity. If you're a long-term equity investor, maybe it is too sudden to leave the equity markets completely because you've seen an increase in your valuation and you're making money after some time. So on both cases, you have to be a bit cautious.
Okay, so should retail investors really worry about the volatility in the stock market?
Volatility is a given in the equity market. So any investor who's in equity will know that you have to be able to stomach both the ups and the downs, and this is something that's going to continue. Now, having said that, recent volatility has been on the high, measured by VIX as an indicator, and therefore one has to be cautious. Now, what does one do to manage volatility? In some senses, for your long-term portfolio, you may just want to watch it more carefully. It may not necessitate an immediate action, but it's very important that you watch carefully just to make sure that no part of your allocation is going completely out of a reasonable range. In that sense, if one asset like equity is becoming overweight, then one could look at some amount of pruning or profit booking. On the other side, one should not completely dump equity just because it is now performed and take a timing call, because you never know whether this is the first steps of a very long-term bull run in the market, as many pundits have been actually forecasting for some time.
So Vishal, what is the best way to approach this market right now? Should we keep our money in cash or stay in equity?
I think it's a matter of what your overall allocation is. So if you're underweight equity, if you don't have enough in equity, then it's always a good time to start. And as we say, you should start on a regular basis rather than just make a lump sum investment. However, if you've got long-term money in equity and you've got some fresh cash coming, then one could look at risk return. And immediately there is some reasonable opportunity in fixed income as well. One has to remember that. So fixed income does offer very, very attractive rates even now. So that could be something which is quite attractive for a more conservative or a more risk-averse investor.
And finally, Vishal, give us a laundry list of the funds you would recommend to investors who are worried about volatility. Could you give us a list of names that as a house you would recommend?
I think if you're worried about volatility, then maybe equity or overweight equity is not a place for you to be in. You should look at fixed deposits, or you could look at short-term fixed income funds. So I would say start with fixed deposits if you really want safety and security and you want a defined return, and rates are quite attractive right now. If you can stomach a bit of volatility or minor volatility in NAV fluctuation or mark to market, want to retain liquidity and have tax advantages or benefits, then you should look at short-term income funds. I do think that that's an area that's probably the most attractively positioned right now. So short-term income funds with less than maybe 2 years worth of duration are probably the most valuable in the current scheme of things, and that's something I think you should look at. Some of the tax-free bonds that were offered are also quoting at very attractive rates. So those are things, again, if you think you want to buy it from the secondary market, might be an attractive buy.